And 3, 2, 1. Welcome to the show.
Sounding a little raspy there, my friend.
If you can't tell, I'm not doing a pretend radio voice. Got a little bug or something while we were out of town, and I will probably not be doing much talking today, which probably will make a lot of people happy. It'll mostly be Jerry.
No, that's all right. That's all right. I got a pretty good one I got to go through, and it doesn't require a whole lot of interaction. So
well, good. Let's get right into it.
Let's get on it. It was a crazy week on the market. We do weekly charts, usually the 3-year weekly chart on the show, and I go into much more of a compressed time frame on the in the newsletter for the paid subscribers. And so we're going to be talking a lot more about this week and what happened and what the ramifications are and new lines in the sand and all that, both on the upside and on the downside in the newsletter this weekend. But for the show, we're going to kind of go back to the basics a little bit. So kind of applying the technical analysis stuff that we look at. So trend lines, moving average lines, and Fibonacci retracements. The only thing in there that I didn't add, I might do it, I'm sure I will do it again, but Elliott wave count. So between trend lines, moving average lines, Fibonacci retracements, and Elliott wave count, that's pretty much everything. Certainly the vast majority, not everything, but the vast majority of my toolbox. And I use them in all kinds of different ways over different time frames, but we're going to go over these three today. And bonus chart is going to be Bitcoin, because Friday, I think, potentially is a pretty important day for Bitcoin. This Friday we just passed. And then the TSP fund charts. Okay, so apply technical analysis. All right. Trend lines, right? As always, the best thing for me to do is use Investopedia to kind of give you guys sort of the basis of what we're talking about, and I can kind of add my own little spin to it. But that's the link there to Investopedia. There's a lot more in this article. This is just kind of the basics. So trend lines, easily recognizable lines that you can draw on a chart to connect a series of prices together or show some data's best fit. Okay, it's an art. It's not a science. The resulting line is then used to give traders an idea of the direction in which the investment's value might move, right? We're looking at a chart. If the line is connecting lows, the price is moving higher. It's just a general direction. So trend line is a line drawn over pivot highs or under pivot lows. So what that means is when we say we're connecting the tops, we're connecting the pivot highs. When we connect the bottoms, we're connecting the pivot lows. And it shows the prevailing direction of price. So trend lines are a visual representation of support and resistance in any time frame. So you can look at it in a 100-year chart or a 5-minute chart, and it's the same idea. You're connecting the tops or connecting the bottoms. They show direction and speed of price and also describe patterns during periods of price contraction. All right. So what does it look like for us? I'm going to basically use the same two charts all the way through trend lines, moving average lines, and Fibonacci, right? So the first one is the long term. It's the C fund, and each tick, right? Each one of these ticks is 1 week of price movement, and we go back to 2009. Okay, so this is the long term chart of the C fund back to 2009, which you can't see it on this chart, but we were up here and we came down in this big move, and we had a very significant low down here in 2009. Okay, so all I did was start at 2009. And I connected the significant lows all the way along, right? COVID was an overshoot. Again, it's an art, right? Not a science. You could connect COVID. It would just change the angle of your line, and you would only have 2 points. So you get more kind of stability at the trend line by the more points you have, right? So I just called this one an overshoot, and we keep going. So this is a long-term trend, right? So a couple things it tells us. We talk about, and you hear in the media all the time, we're in a bear market or in a bull market, right? And we kind of define a bear market as being 20% down from the prior high, right? So here we were at about 4,800 at the high, and we're roughly 20% down here at about 3,800, right? So technically, well, not technically, but according to that definition, we're in a bear market, right? Because we're off this percent from the high. Another way of looking at or defining a bear market is to say we're in a bear market when the trend is down, right? Now, in this case, the trend is only from the top in January, right? Since then, the trend has been down. But if we go back to 2009, the trend is still up, right? So we can argue we're still in a bull market. It's just on a different time frame, okay? So when you're looking at a long-term chart like this, going back to 2009, we're still in a bull market, and we would still be in a bull market all the way down, to about 3,000. If this trend line breaks, we get a price close down here, price is likely to keep going, and now this trend line, where it acted as support all the way along, now starts acting as resistance. And then, if that was to happen, things would get much uglier than just price being down here at 3,000. But that's how you would use it on a long-term chart, okay? And again, it's an art. It's not a science. You're just trying to connect the lows. So the second chart we're going to use for the rest of these is a 3-year weekly. So it's still the C fund. It's still each tick is a week, but it's only 3 years long, okay? So I did the same thing. I connected the main lows that we had after we recovered here from COVID in 2020, right? Connected the main lows. And then now you can kind of see more. We talk about it every weekend, the significance of that down move in January. It broke that trend line. So this bull market, right? The price is moving higher. This bull market didn't technically end, but it was challenged when the trend line broke. From a trend line analysis perspective, it ended right there when we had a high and a lower high, and now we can connect a downtrend. So in a downtrend, you're connecting the tops instead of the bottoms. Okay, so this chart is pretty good. It shows when you connect the bottoms, price is moving higher, you're in a bull market. When you connect the tops, price is moving lower, and you're in a bear market. Okay, so in the big scheme of things, on a 3-year weekly basis that we're looking at, until price gets back up here above that trend line, the trend is still down. Okay, so you can buy and sell in here and try to make those gains and avoid those losses or whatever. But as long as we have consistent lower highs, if the market comes up to that trend line and rolls over, we have consistent lower highs, we're in a downtrend. And it's the same thing on this side. As long as we have consistent lower lows, we're in a downtrend. Okay. So that's some basic trend line analysis. You can do it just by looking at the chart, and it's pretty simple. So the next one is moving average lines. It's similar to trend lines. It's a little bit more sort of math-based. You're not just eyeballing it. So moving averages are technical indicators that we can use to use in the stock market, whatever. A moving average represents the sum of the closing prices of a security over a specific period of time. So it can be a 100-day moving average, 200-day, 20-day, monthly, weekly, whatever. And it's then divided by the total number of periods. So a moving average is depicted as a line chart that's superimposed over the stock price. And we're going to show it, but you guys have seen that a whole bunch. We've done it plenty of times. So once a moving average is calculated and plotted on the chart, it can be a powerful visual trend spotting tool, kind of like a trend line. If a moving average line is rising, it can signal that a stock is in an uptrend. Conversely, when a moving average is falling, it signals that the stock is in a downtrend. So if we look at the indicators, okay. So the same charts that we had before, except instead of the trend lines, I put in blue is the 50-week moving average, and in red is the 200-week moving average. So we've talked about this this 200-week moving average line before. Actually, we talk about it quite a bit. Once we got back above, so the red is the 200-week moving average line, right? Once we got back above it after the low in 2009, every time we came down and corrected to it, we got support there, right? We had a little overshoot in COVID, but now we're right back to that 200-week moving average line, okay? That's the long term. It's the longest term trend moving average line that I use. I also put in the 50-week moving average line in blue, okay? So you can see that most of the time, price finds support at that 50-week moving average line. And when it doesn't, it tends to fall down to the 200, right? That's where we are right now. We were above the 50-week moving average line all throughout, after COVID and through 21 into 22, and it broke that 50-week moving average line and then collapses down to the 200-week, which is where we are right now. So we're in a really critical place, right? We got support for the time being anyway, right there at that 200-week moving average line. Okay? It didn't close below it. So that little line that goes through it that you see, the little red line, that was 2 weeks ago on a Thursday, I think it was. We ticked down and we got just barely below 3,500 for like a minute or two, and then price came back up and ended up closing for the week above that line. So that's called a wick, and it's not important really. If we had done a line chart instead of a candlestick chart, then you wouldn't see that wick at all. You would see it come right down to that moving average line. So that's what it looks like on a chart back to 2009. So the 3-year chart of it. In this case, I kept the 200-week moving average line just to show that really, we are right on it. We've been banging on that 200-week moving average line now for 4 weeks. And this week and last week, we're above it. But we're right really, in the big scheme of things, we're right on that line still. The blue line is the 20-week moving average line, right? That's the one that we show at the end of the show every weekend. 20-week moving average line, we get support, and then we get that break through it in January, which was the beginning, of the bear market that we've had all year. And while it was support back here, it becomes resistance because we can't get above it and stay there. And that's what happened this week and last week. So if we kind of drilled into that, last week we ended, right, in that white rectangle was the end of last week. So we ended last week at the top, right at 3904, right at that 20-week moving average line, but we couldn't get above it. And then this week, you can see that wick is just barely above it. So at some point this week, we were above that 20-week moving average line. And then the market rolled over and came back up on Friday. So you can see that we actually closed kind of in the middle of the week's price move. So it's a pretty good, for now anyway, it hit resistance at that 20-week moving average line, couldn't get above it, and rolled back over. So now we're in between the 20-week and the 200-week. One of them is going to win out, right? If price moves higher and we get up here to say 4,000, we're clearly above that 20-week moving average line, then the odds increase. It doesn't mean it's going to happen. It's just that the odds increase that price continues higher from there, and price can't continue higher unless it gets above that line, right? Obviously, that's kind of stating the obvious, but the first indication that the trend has changed will be when price can get above that 20-week moving average line. We would definitely prefer to see that happen rather than price closing below the 200-week, because this will be very significant. Okay. Fibonacci retracement levels. So we use these quite a bit. This is kind of a basic idea of what they do. Fibonacci retracement levels stem from the Fibonacci sequence. There are horizontal lines that indicate where support and resistance are likely to occur. Okay, it doesn't mean they will. It's just historically that's where they're likely to occur. Each level is associated with a percentage. Percentage is how much of a prior move the price has retraced. We'll take a look at that. The normal retracement levels are 23.6%, 38.2, 61.8, and 78.6. 50% is not an official Fibonacci ratio, but they put it in there because for whatever reason, a lot of times price either stops falling or stops rising at that 50% retracement level. The indicator is useful because it can be drawn between any two significant price points. So you pick a high and a low, and you want to see what the retracement is in between, how much it retraced, and those are the areas you're expecting to see some support or resistance. Indicator will then create the levels between those 2 points. So big takeaways: Fibonacci retracement levels connect any 2 points that the trader views as relevant, right? You can put the points anywhere you want, typically a high and a low. Percentage levels provided are areas where the price could stall or reverse. They say, I'm calling it support or resistance. The most common used ratios we said, and this is kind of the most important one. These levels should not be relied on exclusively, so it's dangerous to assume that the price will reverse after hitting a specific Fibonacci level. Okay, Fibonacci is just one tool, so you definitely, I mean, you can do it. It's there are people that only trade on Fibonacci's, but it's a lot better to combining tools together. Okay, so here's what it looks like. The same long-term chart. If we started down here in 2009 and we wanted to know the retracement level, so we had this huge move from 2009 to 2022, right? If we want to know how much price has retraced, we put the cursor here and we drag it up to the top in 2022, and the software gives us these lines. Okay. So the first Fibonacci retracement level, these are the three big ones: 38.2, 50%, and 61.8. Those are the big ones. So 32, so roughly 3,200, is the 38% retracement level of this whole move from 2009 to 2022. Okay, so a lot of people are looking at that 3,200 level. That's one of the big reasons why you hear that that's a level that people are looking at, because it's the 38% Fibonacci retracement level of that move since 2009. 50% is also a big one, and that's about 2750. Okay, so if we get support at 38.2%, great, and we start moving higher, somewhere in here, if we drew the trend line and the price keeps coming down to the 38, once it gets support there, comes back up and gets above the trend line, maybe that's a place you want to get back in. Because we can, in hindsight, we can say, okay, it looks like we got support at that 38% retracement level, and now we broke out through that downtrend line. So your odds increase dramatically that price is going to keep going higher. There's no guarantee, but your odds increase dramatically. If we break through that 38% retracement level, chances are we go down and test the 50. So that's where people, short the market, right? If it breaks through some of these levels to the downside, you can short it expecting it to get down to the 50 or down to the 61.8. So one of the arguments for, we're going to get back down and retest these COVID lows, it's because that's exactly the 61.8 retracement level of this whole move. So it wouldn't surprise me at all. It almost acts as a magnet, coming back down to that prior low, and it's this Fibonacci number. Wouldn't surprise me at all to get all the way down there to 2250. Okay, that's the big scheme of things. If we drill it down into that 3-year chart, and we use the COVID low as our low, and the 2022 high, okay, so we did the same thing. This was the first starting point. We pulled it up to the top in 22. The software draws the lines, and we can see that we hit at the October low right at that 50% retracement level. So 50% of the move from the low in COVID to the high in January, 50% of that move is gone at that point right there. And so a lot of times, 50% is where we see support. We also know that October tends to be a low that sets us up seasonally for a big fourth quarter, right? And there's all this talk about the market was way oversold and all these other reasons why the market should have gone higher. And so when you overlay all those things on top of each other and you see a reversal like that, there's a pretty good chance that you're going to get some kind of recovery rally, which we had for 2 weeks. Right? Okay. So that's how you would use Fibonacci in a little bit shorter time frame. And then I just wanted to kind of combine two things together, right? So this is the same chart we were just looking at, and all I did was add that 200-week moving average to it. So the 200-week moving average hit right at the same time as that 50% retracement level. And you get the seasonality factors that, are supposed to be good for a fourth quarter in years ending in 2. And you get a midterm election, which is supposed to be bullish for stocks. So there's all these reasons to expect that we would get support for some amount of time anyway, where we did. And we did get it. And we rallied for 2 weeks. Whether or not this rally is completed remains to be seen. And that, again, is what the newsletter is going to be about this weekend. So if you want to hear about that, sign up at growmytsp.com. If you're already a subscriber, definitely you want to read this weekend's newsletter. Okay. Bonus chart is Bitcoin. We haven't done bonus charts in a little while, but this one's for Conan. He can't talk, but he'll appreciate it as we're going through it, I think. Okay. So a couple of charts about Bitcoin. This is going all the way back to the beginning of Bitcoin, at least on this chart. It's probably, it certainly was in the formative stages before 2014, but in stock charts, it goes back to 2014. So this is what a standard price chart looks like, right? It's not logarithmic. It's a standard price chart. Okay, so it moves 5,000. So we're at 50,000 here. It moved to 55,000, 60,000. So it's every 5,000 on the y-axis. And since it's so volatile, you get these big, huge moves up and down. Right? So the only way to really look at it is to look at it in logarithmic scale. It looks like this move is much bigger than this move, right? When you're looking at price. I mean, it just looks like all this is where everything happened in Bitcoin. Okay, so that's one takeaway that we'll think about, but we'll look at it on the next chart. So from basically, the middle of 2020 to the middle of 2022, it looked like that's where this huge move happened in Bitcoin. The other thing to think about or look at is we had this huge run up into 2018 and we topped out at 20,000. Okay. We corrected for a couple years, got back above 20,000 here, and then had this giant move, right? Now we're all the way back down and we've been banging on that 20,000 level, give or take, for the last several months. Okay. So this is pretty important support. That's why we're banging around at that level right now, because the last high is right here at 20,000. And yes, we've gotten a little bit below it and a little bit above it. We're like banging right around that line. If we break down here to say 15, we probably go back down to 5. All right. So that's what it looks like on a regular price chart. This is the same chart, but it's logarithmic. Okay. So you can see that on a percentage basis, because that's what logarithms are, the biggest move happened back here into 2018. This move that we had from 2020 to 2021 on a percentage basis is very small, right? It's the reverse of what this looks like. So if you're looking at price that moves a lot or time that moves a lot, it's way better to look at it and understand really the value of the move in logarithmic scale rather than regular price scale. But we still have 18,000 here, 20,000 here at the high in 2018, and we're banging along that $20,000 line right there. Okay. So if we zoom in, this is 3 months on Bitcoin, and we can see that this is the section. When I was saying we're banging along that 20,000 line, it's a little bit below it, but this is the area that I was talking about. We're hammering along that area, trying to decide which way it's going to go, right? So when we zoom in, now it's a 3-month daily chart, and we applied a 20 day moving average line. Okay. So we just talked about moving average lines and what they mean. We crossed down below that 20-day. Couldn't get above it. Came down, stayed below it. Huge move above it here, right? Rolled over and couldn't get support at it. It came down again. Can't get above it, can't get above it. Gets above it, can't stay there, rolls over again, right? Along. We get above it here, right? Which isn't too much different than this or this, right? So what's the big deal about this one? Why does that one matter? Because when we rolled over, we hit that 20-day moving average line and exploded higher off it. We got support there. You want to buy something on the retest. That's what that means. We came up through that 20-day moving average line, came down and retested it, and exploded out higher. That's where you want to buy it, whether it's Bitcoin or anything else you're looking at. That's a big buy trigger. And the other thing I put in here was volume. So volume on that buy day was pretty big. A lot of people were buying Bitcoin on that retest. So it probably goes higher from here. I would think it at least up to this prior high to begin with. So if we are at the beginnings of a bull market in Bitcoin, you're looking at it right here. It's absolutely possible. The other thing that kind of supports that idea is that if you look back here in August, the volume, there's way more red than there is black, right? Red is on down days, black is on up days, and even on the up days, the volume level is much lower than the volume level on the down days, right? As we go forward in the chart, you get a whole lot more black days in here. So there's a whole lot more positive days, but we still have a lot, the negative days are bigger volume, right? So that's not good either. It means more people are actually selling, even though the price on any given days, the price is going up more frequently, but there's more volume in the selling. And then we move kind of forward to where we've been in the last couple of weeks. We got more positive days, and those positive days are on much bigger volume than the negative days. So there's a lot of momentum that's being built behind the move. So it acts like a spring. Like there's all this churning going on in here, and you can start to see that it's starting to explode out because people are buying it. High volume on the up days, low volume on the down days. We're getting support at key resistance levels, and we have a big price breakout day. It's a way you use technical analysis to identify when you want to actually buy these things. Okay. So hopefully that gives you guys an idea. I'm not saying go out and buy Bitcoin. What I'm saying is this is how you use the tools to identify trades that are least risky. And so one more thing about that. If price rolls over and gets below 20,000 right here at that 20-day moving average line, sell it because it's going lower. It's going to come back down and test this 1900, 1850 level again. It'll be a failed breakout. That's what that would be called, a failed breakout. But the great thing about this is your risk is defined, right? If this is your line in the sand to get out at 20,000, this is what you're risking, but your potential gain is at least up to here at 23. So that's how you use it. Okay. Doing all right over there, brother?
I'm hanging in there. I had a lot of thoughts, but no way to talk.
Yeah, I saw you writing, but yeah, that's okay. All right. TSP fund charts. So I shouldn't say not a lot has changed since last week. Real quick, again, this is the 20-week moving average line. We looked at that before. We got support all the way through it since COVID, and then we lost that moving average line in January, and we haven't been able to really get back above it since. And so we're really watching that line, right? We have lower lows. which is not good because at some point we need to have higher lows and higher highs, and that defines a new uptrend. So we're not even anywhere close to that yet. But last week, we've closed right on that 20-week moving average line. And then this week, we rolled right over. So on a weekly basis, you wouldn't have bought it last week because we were still below it. We were on it, but still below it. And then this week, it rolled over and kept going lower. We also had RSI come, didn't quite get up to 50, and it rolled over this week. So from this chart on a weekly basis, the trend is lower. And so there's no reason to be buying the C fund at this point. S fund. Very similar, right? We got all the support at the 20-week moving average line up here. We lost it back here in November 21. Haven't been able to really get it back above it since. The only time we've gotten above it in 2022 was that summer rally. And again, last week, the week before last, closed right on the line, and then this week rolled back over again. RSI below 50, so no point in being in the S fund at this point. And again, this is on a 3-year weekly chart, so when I say there's no point in being in it, I'm referring to a weekly chart, not a daily chart. iFund is interesting because iFund was the only fund that was up this week. And I don't really want to get into the dollar was down this week, which there's a whole bunch of shenanigans going on. The Fed is opening up a repo market. The Fed is basically going to allow European banks to have access to dollars, which is going to decrease the value of the dollar, which is going to increase the value of the iFund. And we'll see how long they're able to do that, because if they do it for very long, it will also increase inflation, which is their biggest thing that they're trying to not have happen. So we'll see if this up week in the iFund was a one-off. But again, nothing really different for us. iFund is above that or below that 20-week moving average line. RSI is below 50. So while, on a very short-term basis, iFund looks like it's going higher until we can get above that moving average line and above 50 RSI, there's no point in being in the iFund. F fund continues to be a complete disaster. I heard a stat today. This is the worst single year since 1788 for bonds. So what that means is, and this is actually I'm going to push it out. It was the Wealthy on weekly market recap, and I'm going to push the video out at some point this week. But they were talking about bonds, and everybody always says if you're when the market's going down, I want to be a buyer. I love it when the market goes down. It means I'm buying shares cheaper and all that. This is so like everybody says, when the market's going down in 2008, if it ever does that again, I'm going to back up the truck and load up on stocks and all that, right? And right now, so we've been talking about it all year. When do you know it's time to back up the truck, right? If the trend continues down, when do you know when it's time? It doesn't have to be the bottom, but when do you know when it really is time to back up the truck, right? This is the worst year in 250 years. Like, yeah. I mean, so what Lance is saying in the show is like, hey, if you're like he's saying it can definitely go lower from here because he doesn't have a crystal ball either. He doesn't know how low it's going to go. But the snapback just to get back to like the median of this would get you 50%, a 50% move on maybe not the F fund because the F fund is half corporate and half treasuries. But if you bought the ETF is called the TLT. If you bought long-term treasury bonds at some point, over the next year or two, you're going to make 50, 60, 70%, 100% of your money on a very, very low risk because 20-year treasury bonds are about as low risk as you can get. This is an environment that is like back up the truck and buy as many as you can. And we're not at the bottom yet. Certainly not by what this chart looks like. So, so there's, the bond funds are just, obviously it's a 250-year snafu in the bond fund. So anybody who tells you they know anything other than it's way oversold on a ultra historic basis, anything else is just complete speculation. But again, you could do the same thing until price gets back above that trend line. It can't keep going higher. Now, the problem with this is from 94 to 98 is a pretty big percentage move just to get back to the trend line. So, if you wait for it to get that high, you've given up a lot of gains. But again, it can keep going down and, whatever. So if you're watching the show, we will definitely let you know when we think it's a good time to buy it. And if you're a subscriber to the site, you will definitely know when it's a good time to buy it. And then one other thing I'll kind of throw out, I think, the F fund is likely to bottom and move higher as the stock funds continue down. So at some point, it's probably going to be much better to be in the F fund than to be in stock funds as this recession starts playing out in 2023. That's as much as I'm going to crystal ball that one. All right. You got one? You got another one? This one? Next one.
I was trying to get you to say questions.
Questions. Sorry.
Questions. I ran out of voice there for a second. I had to take a drink. All right. If you have questions, put them wherever you find in the comments section.
Everybody knows the drill by now.
Yeah, put them in the comments section wherever you found the video. If you don't have a comment section, then email us, support@growmytsp.com. Hope you guys had a great week. I know it's been a very tough time watching the market.
Yep.
We've had a hell of a week. So, let's keep our eyes on the ball and keep pushing forward.
Yeah, that's all we can do. I mean, we're in this historic bear market, and it's difficult. It's difficult for everybody. So, all right.
Have a great week, guys. We are
later
out of here.